for joining us at the Virtual Network for Financial Intermediaries. My name is Kevin Hinton. I'm the founder and owner of the Collaborate Exchange. As many of you know, we are responsible for many of the large investment events throughout South Africa, namely the Investment Forum, Meet the Managers, which is coming up in August this year. You should be receiving communication from us about this event in the next number of days, where you'll be able to access something like 28 fund managers during the course of a given week during August to get insight from both domestic and international fund managers on the state of global financial markets. But let's not go there on that point immediately. You're here this morning to listen to Jacques Conradie, who's the CEO of Peregrine Capital. And for those who've been watching our webinars in the last couple of weeks, you would have seen we've had an enormous amount of content around the active asset management sphere, and you've probably heard views and insights from numerous fund managers domestically, internationally, on the state of global markets. Just before I get into Jacques, and Jacques going to take you through a presentation, and we're going to have a Q&A function, which, as you know, on the application, the interface, you can actually send us your questions, and we'll endeavor to deal through those throughout today's session. But for those of you new into the virtual network for financial intermediaries, this is a new infrastructure we've set up subsequent to the lockdown and COVID-19, which enables financial advisors to network and to meet virtually. The application has something like 1,700 financial advisors and industry professionals throughout South Africa on the site at the moment. And you can actually reach out to those individuals if you so wish, and you can in fact meet them. You can come into all of our event webinars we've been running. You can actually go back and view the historical webinars we've been running. So if you click on the dates in May or in June, you can view any of those webinars at your leisure. And what it also does, it actually gives you a synopsis of the webinars that we're looking to run at some future date as well. So you can click on the calendar and see what's coming up. You can save it, you can bookmark it, for example's sake, save it into your diary to ensure that you're alerted to that particular webinar that will be running over the next couple of weeks. It also allows you to connect with speakers. It allows you to connect with organizations, other like-minded financial advisors. You can search by type of advisor on the search function on the virtual network. And if you wanted to meet all advisors that have interest in, for example, say hedge funds, it's a simple search function that you can do on the application to determine that. So really, we'd encourage you to, post this webinar today, to go back into the virtual network, go and like this session, because it'd be great to get your feedback and get a rating system. There's a 5-star rating system you can attach to this particular event. This session is recorded as well, so you can actually view it after the event as opposed to watching it live. You can also share it via your virtual platforms as well. These sessions aren't yet CPD certified, but however, from the 1st of July onwards, all our webinars will be certified by the Financial Planning Institute, and we'll alert you to that in the next week or so. And so, getting onto this sort of subject matter, and I'd like to sort of perhaps bring Jacques in here this morning. I think you all know I don't necessarily spend a lot of time introducing the speakers. Their profiles are contained in the virtual network. You can go and read up about them. All the people we have on these webinars are professional investment managers in their own right, and they probably need very little introduction to yourselves and the audience in any event. And we've asked Jacques to come in this morning and really just to talk to us about this world of alternative investments. As you all know, at the peak of the markets correcting themselves in March this year, the VIX, or the volatility index, was at an all-time high. It's sort of trading about 80 times. And one would think that this is the feeding grounds for the hedge fund industry, where they can either short or go long on securities, as they read the scenarios. And so we've asked Jacques to come in this morning and maybe just give us an update of really what's been happening in the hedge fund and alternative investment management sphere, and how hedge funds have been holding up in the sort of COVID or in this market volatility period, and particularly how retail advisors can get access into the Peregrine hedge funds that Jacques and his team actually look after. So, firstly, good morning, Jacques. It's, I should say good afternoon, Jacques. It's great to have you here. Thank you very much for joining us. And are you coping well under this COVID lockdown period?
Hi, good afternoon, Kevin. Yeah, look, it's been a it's been a very strange time the last 4 months. I think for all of us looking back, it's probably going to be one of the strangest and perhaps most difficult times of our lifetime, the last 4 months, and probably, to be frank, the next 6 months in our opinion. But I think our business has coped well. It's been actually a very interesting time to run an asset manager, and actually it's been a really great time to run a hedge fund, to have the additional tools at our disposal, because you've needed your real full tool set here to try to navigate your clients through this time. So while it's been really difficult and you wouldn't wish this period on the world, I think it's actually been quite an interesting and somewhat enjoyable period for us, trying to really just figure out how to react and how to position the portfolio for this event that no one has ever seen or foreseen.
Jacques, thank you. And I know you're going to take us through a slide presentation now. So if you'd like to, I'll hand over entirely to you.
Okay, great. Thanks, Kevin. So I'll maybe just start and give you a quick overview of what we want to discuss in this time. So I'll just start off quickly with a little bit of history about our firm to give you guys some context of the people that don't know Peregrine Capital. We haven't been a brand that's been as out there as we could, so just give you a little bit of overview. And then I think that the real key thing I want to address today is what are the three most important things when you're trying to select a fund to add to your portfolio. And I think, in my opinion, you always have to start with returns. What are the returns that fund can provide? But then number 2 and 3 are as important. Number 2, in our opinion, is how does the fund manage risk and manage your downside and protect you in difficult times in the market? Can the fund deliver good returns in tough markets? And then thirdly, how does that fund improve the overall client portfolio when you include it? Does it improve diversification? Does it reduce volatility? And does it enhance returns? So really, in the presentation, I want to touch on those 3 things being almost the key variables we think in selecting a fund manager to add to the portfolio. And then obviously, we also want to spend a fair amount of time just on what's going on in the world. How have we repositioned the portfolio? What have we done to ensure that our clients continue to achieve our performance in this difficult time? So I think from there we can get the slideshow going, and I'll take you through. Right. So to start off with, Peregrine Capital was started in July 1998, and we're the longest running hedge fund in South Africa. Actually, basically from tomorrow we're 22 years old. It's been a great track record over that entire period of time. We currently actually, I think we've got on the start, we're managing around 6 billion of investor money. It's up to about 7 billion right now, given performance in the last few months and some client demand. And then I think we've just got a really experienced team with about 100 years of combined experience in financial markets. Many of you would not potentially have heard of us before, and I think the reason for that is we've been fairly conservative to manage our fund capacity. I mean, we're a very returns-focused business, so for various times in our 22-year history, the fund's actually been closed to new investment, and we're fully filled up by pension fund, high net worth clients, and institutional investors. However, over the last few years, we've decided to change focus and pivot our strategy to actually start building a brand and start telling retail investors and IFAs about our story and about the value we think we can add. So, I mean, just to give you some context, I think in the hedge fund industry, we recognize it's probably the most successful hedge fund in the country. If you look at the Hedge News Africa Awards, which is the major hedge fund industry award ceremony, we've won the 5-year performance award, which is always the most important one. I think we've won that 6 out of the 8 years that the award's been running. We've won it. So I think very well recognized in the hedge fund industry. So let's actually get on to the 3 things I want to discuss when selecting a fund, and I think it starts with returns. So for the returns part, we've said, I think in explaining our fund to IFAs, we've said, let's compare our fund since inception versus the whole collective investment scheme industry. Let's look at whatever else is out there in all categories, how would an investor have done our product versus any other product in the collective investment scheme space. So for our pure hedge fund, what we did is the fund started in 1998, as I discussed earlier, and we set out the entire 2000 fund universe. What's the next best fund in SA, assuming you literally picked the best out of the 2,000 unit trusts in that time, and how did that fund perform versus PureEdge in that time. As you can see here, I think PureEdge has delivered fantastic returns for clients at that time with a 5,700% return. So that means 1 million Rand in day one is worth 58 million Rand now, and for the next best fund, 1 million Rand is worth 24 million Rand. I guess the additional pleasing thing for us is the way we manage this fund is it's on a very conservative mandate where we at all times protect the downside of investors. So we aim to deliver returns above inflation while also limiting losses in the fund. In that entire 22-year time, has actually never had a negative year. So over and above outperforming any other fund in the country over this time, it's also had significantly lower volatility, and it's been a much smoother journey for investors. So this fund is a market neutral hedge fund, which means we take very low actual equity risk, and we more focused on our alpha trades, which means our outperformance trades, which shares will outperform which other shares, and we're also very focused on hedging, so making sure we short companies that will underperform, and that we use options and index shorts to also manage the volatility in the fund to ensure that kind of our goal of positive returns over every calendar year. So this is obviously the since inception number. If I now move on to various time periods, I guess the way we see long-term outperformance is that you cannot achieve long-term outperformance by just having 1 or 2 good years. You've got to consistently deliver for clients year in, year out. So I guess the pleasing thing on this graph is that over every time period, 1 year, 3, 5, 10, and 15, we've actually on a very consistent basis outperformed the SA multi-asset low equity category, the stable fund category. It's one of the bigger categories in the SA unit trust space. We've almost consistently outperformed that by about 5% over every one of these time periods, including this year, including the last 3 years, and obviously also long periods of time. So we think this is a great product for everyone, for anyone allocated to that space where clients want low volatility, but they still want to outperform cash and they still want to outperform inflation. If I now move on to our high growth fund, which is our fund that really competes with SA balanced funds, takes similar risk to the SA multi-asset high equity category, so basically similar risk to the balanced fund category. This has been an even better story since inception. The fund started on 1 February 2000, and since inception it's done 8,500% for investors, meaning 1 million Rand is worth 86 million Rand now. And over that time, the next best fund in South Africa actually did 1,400%. So, which means you've got 15 million or so there. So that's more than 5 times outperformance in about 20 years, which I really think leads to very happy clients. And it just shows you the power of compounding over a long period of time. If you can consistently do 5%, 7% better than other funds year in, year out, that adds up to a huge amount over someone's time horizon. I mean, 20 years is a very relevant time horizon for someone that's saving at 40, for 60 or 65. 20 or 25 years is a real time horizon you think at. And for someone to have 5 times more money at retirement, that's obviously a very, very material change in living standards for someone like that. So I guess that's really what makes us happy and what makes our clients happy. Again, as for the PureEdge fund, we have not taken more risk to achieve this outcome. We've taken similar risk to SA balanced funds, and I think we'll touch on the downside protection later. I think we've actually typically massively outperformed in down markets, so protected clients' money better than the typical SA balanced fund has. If we again move on to the graph where we look at things over all the different time periods, again there we've achieved the goal of over every single measurable time period, we have consistently outperformed. There's not one time period where we've lagged the peer group and also the market, and you'll see over the long-term time horizons, the 10 and 15-year time horizons, we've done about 10% better than the SA multi-asset high equity category. So that's about, similar risk to a balanced fund, but 10% higher return per annum. And then especially over the last year, it's been very pleasing with not a high absolute number. We're up around 5% over the last 1 year period, but in a market that's down almost 15, I think that really is exactly what is the type of promise we make clients, that in good years, we're going to outperform the market, but in down years, we're going to protect your money and still try to put some runs on the scoreboard for you. So I think this then covers that return point where I think there's no doubt that I think the product delivers a fantastic return outcome. And I guess what I want to touch on now is at what risk does it do that? How does it protect downside? And then we'll move on to what it adds to an overall portfolio. So I guess this is this slide just gives you some context where our funds fit in on the risk return spectrum. You have stable funds, high equity balance fund, equity funds as almost the three major risk buckets. And we've positioned pure hedge to be the same risk as the stable fund category, and high growth the same as the balance fund category, yet with substantially higher returns. Over 15 years, about 5% higher for pure hedge and about 10% higher for high growth. And I think for the first time now, we want to make sure these funds are also easily accessible to IFAs and retail investors. So while we've always been open to direct investment, we have made an effort to get listed on all the major platforms. Both our funds are currently listed on the Momentum platform, and actually the High Growth Fund is now listed on the Allan Gray platform, and at the end of next month, the Pure Hedge Fund will also be on the Allan Gray platform. So we've done a great job, I think, increasing accessibility. I think we'll probably end up being on Glacier and Investec as well in the next 3 or 6 months. So really making our funds a realistic and easy choice for clients who wanted to allocate on those platforms, and picking between the Coronation or the Allan Gray or the Investec Balance funds, having this as an alternative to improve the return and reduce the risk in a portfolio. So let's look at how we manage the downside. As a hedge fund, I mean, the whole reason we run hedge funds is we think that's the best tool for growing your money long term. For our fund management team, myself, David Fraser, our founder, we've got the majority of our net worth invested in the funds alongside our clients, given that we think this is the best way to compound our own wealth long run. We can achieve great returns, but we've also got various tools to protect downside. We can short individual shares that we think will underperform, like African Bank a few years ago. EOH was a great short for us last year. And then also just the ability to rapidly use index futures and put options to protect the funds is a very key attribute we have. And we're going to touch on that in a few slides' time to just show you how we've navigated the coronavirus crisis. So to just touch on our funds, the Pure Hedge Fund, as I said, it's in 21 years, has never had a negative year. This year, even the first quarter when the market was down more than 25%, Pure Hedge was up. In 2008, when the market was down significantly, still ended the year up. It's actually the peak drawdown being the biggest fall from any point at any month in to another month was 5% before we made up that. So I think that's a fairly small drawdown that most clients can handle. If I look at high growth, that fund does take more market risk. So it does have slightly higher volatility in exchange for higher expected returns, but still it's at 18 out of 20 years in terms of 18 positive years out of 20 with a max drawdown of 17% versus the JSE Cap Swiss with a 40% drawdown and with many more negative years. Even the positive months, which clients like, has been fairly much more consistent for our funds than for the overall market. So if we move on and look at the key down periods for South African markets over the last 20 years, and I think we're specifically looking at events before this year because I've got a separate slide where we analyze this year in great detail. And you'll see in the early 2000s, in both the small negative years for the markets, our fund actually was up substantially at that time. And then even in the 2008 and 2018 kind of bear markets, the fund was down substantially less than the market, which is really the goal in the negative years. We want to be down substantially less, and then we want to catch the bounce back in the markets and make sure our clients keep up doing a bounce back. This year, we've actually done slightly better, and I think had an even better outcome in 2008 to 2018 because of the way we hedged the portfolio. But this just gives you an idea of how we want to manage the downside. We don't see ourselves in an equity fund. Part of our promise to clients is that we sit with an hedge fund hat on, and we consistently think about risk management. How do we manage your downside? How do we ensure that your clients lose less money from the peak to trough in their markets? Let's now move on to the third key aspect of, I think, selecting a fund. And we think without a doubt that should be, how does adding this fund to an overall portfolio improve the return and risk characteristics of that portfolio? So while a fund might be great outright, and me as a fund manager, I've got 60-70% of my net worth just invested in my fund. I don't have a portfolio of funds because obviously I can see what we do on a daily basis. Most clients will choose our fund as part of an overall portfolio. And how will our fund influence that portfolio versus just adding, for example, one of the big SA balance funds? So what we've done here is we've taken the 5 biggest funds in the SA market, so I think these are just equity and balance funds, and said how are they correlated with the overall return of the JSE. And as one would expect, they are extremely highly correlated, 85 to 95% correlation between these funds and the overall market, which means one thinks you are diversifying, but often with these funds, you're just taking many of the same positions and many of the same bets. And as one would have seen earlier this year, when the funds are down, they're typically all down. Maybe the one's down slightly less and slightly more, and there's been one or two star performers this year, but mostly things have just fallen with the market. And I think this is where our funds really differentiate themselves. And even the high growth fund, that's a fairly high equity exposure fund, is only 65% correlated to the market. And then pure hedge is only 35% correlated with the market, which is really a very low number. So overall, adding these funds to any portfolio, whether it's 10 or 20% allocation, will reduce the risk of that portfolio and increase the returns. And the reason we do that, we can do this, or the reason we can deliver this kind of diversification, is just because we've got different ways of making returns than other clients. We just don't own the same large companies as in the index. We've got very differentiated views. Because we can use shorts, we've got different ways of making money there. And I think we're also real experts in analyzing complex situations in the SA market. So when there's restructurings or capital raises or companies acquiring each other, there's often fantastic opportunities where we've built a real expertise, and you can then make great returns that's uncorrelated to the overall market during those times. So let's now move on to, I think, the interesting bit in terms of how we've seen this year play out and what our funds have done. So again, before I tell you what we've done, let's look at actually how what we've done has paid out for investors, and then I'll get into the mechanics of how we traded and what we did to achieve this. So you'll see in the early part of the year, obviously the market started declining. Cap switch was down 2 or 3% in Jan, then 10% in Feb, and then more than 15% in March. So over the Jan to March period, we had a drawdown of about 27, 28%. So during Jan, both our funds were kind of flat to up. During Feb, we took some pain together with the market, and that was really when we, on a very early stage, recognized the risks that was now facing the global SA economy. So we took some pain on the high growth fund and pure hedge funds as we rapidly repositioned the portfolio to be ready for what we saw was coming. And I think the pleasing thing is then when the real trouble hit in March and markets completely collapsed, our funds were correctly positioned for that environment. And you'll see pure hedge actually ended the month of March up with a 15% or 16% down market, and even high growth was down less than 1%, which I think is really something our investors loved. I think we were one of the few funds in their portfolios that delivered these kind of numbers. And it's really kind of exactly what we targeted for. And it was pleased to see that the actions we took in Jan and Feb to get our portfolio ready for this delivered this outcome. You'll then see in April and May and June month to date, I think we've done a fairly good job capturing the upside from the low. Because we were on the front foot when we entering this, we were able to add risk and add great opportunities and underpriced shares to our funds in the Feb and March sell-off, which then has stood us in good stead as markets have bounced back during April and May. So if we look at this period where this then gets us on a year-to-date basis, is that pure hedge at this stage is up more than 4% for the year. And I think for interest sake, we just put your average income fund is actually only at 1%, which shows you even funds that were supposed to almost just give you cash-like returns have found things very tough. And then the average low equity balance fund is down about 1%. So very, very nice outperformance, and while actually never being down during the first quarter. And then I think high growth for a fund with a fair amount of equity exposure. I think this is at the end of May. We've also had a nice June, but at the end of May even, we were up for the year up about 1%. Versus a market that was still down 60, 70% at that point in time, and the average balance fund being down around 5%. So I think really both limiting clients' downside and then ensuring as things bounce back, we capture that. So let's look at some of the key things we did during the year to ensure this outcome. So as COVID-19, I mean, as we all became aware of this in January, initially the world very much thought this would be a China-specific story that was unlikely to spread to the rest of the world. We, I think, with our backgrounds as fundamental analysts, and we've got a few actuaries in the team, myself and one other team member, and then the rest of the guys are CAs, I think generally our eyes open wide when we see any exponential curve, because exponential curves are different from linear curves. They accelerate very, very quickly on you, and they often look like nothing right now, but then in 2 weeks or in a month's time, the numbers get very scary very quickly. So we were watching this very, very closely. And I think the key thing we were looking for was there any indication that this would spread beyond China? So that was the real signal we were waiting for, to say, can this be contained in China or will it spread? Our signal for that was on the weekend of the 24th of February, where we basically saw the Italian cases spike from 3 cases to 200 cases over a weekend. And that was a signal for us that there was now no way this would be contained. It was going to spread globally. I think the amazing thing at that point in time is that markets, I mean, this is the graph for S&P, literally global markets were at an all-time high while this was happening. So basically, we got in that Monday morning, like at the crack of dawn. I called the whole team in. We sat there, we debated this on how to act and how to protect the portfolio. And before the US woke up on that Monday morning, we traded and bought significant put options on the entire fund at the end of Feb to basically protect in the scenario where COVID ended up being a really shock global event. Obviously, that ended up happening, and this looks obvious in hindsight, but clearly this was not priced at the time, given that markets were literally at their all-time high with this kind of news flow going on. So as you can see, and as you would know, things then fell away very, very aggressively, and we probably had the fastest one-month market sell-off that we've had in the history of markets from the 24th or 26th of Feb to the 23rd of March. And that was really the time where these put options protected us. As I just showed in the previous graph, both the funds was fairly close to flat in a market that was down 17%. How do you then deal with the crash when it happens? It's such an important thing on markets to be on the front foot. If you're not on the front foot, then you are the one panicking, and it's very tempting to sell shares at the low or as they fall. I think as soon as you can see things coming and prepare the portfolio for that, that means on the way down, you can then think objectively. You can say things are getting cheaper and cheaper, the outlook stuff, but as shares get cheaper, you've got to be deploying cash in those. So what we did is, as March played out, we steadily sold off a lot of our protection as the protection paid off, and we made good money from that, and then also deployed more and more of the fund into shares, into that market weakness, which has then paid great dividends as markets have bounced back in April, May, or June. If we just look at a few shares that we bought during that time to tell you what we did is, the main thing, the main realization we came to was that the whole COVID-19 epidemic would be an extremely negative event for the South African economy. The only way governments are getting their economies through this is by massive stimulus, cutting rates to zero, and massive fiscal stimulus, unlike anything the world has really ever seen. We realized fairly early on that SA, because of how mismanaged our government has unfortunately been and all the corruptions that's gone on, our balance sheet was not in a shape to be able to stimulate the economy through this environment. So that just meant that SA, we were going to take this on the chin, businesses were going to go under, people were going to get unemployed. That's just the reality of what was going to happen. So we realized fairly early on that we would have to aggressively reposition our portfolio out of domestic SA companies and into global companies. So during Feb, March, and April, we actually turned over about 100% of our portfolio as we aggressively traded out of some shares and into other shares to reposition the portfolio for this new world we're facing, and to ensure that we can generate great returns for clients, even with the COVID pandemic raging across the world. So, I mean, I think it takes, I mean, a lot of conviction it took a lot of conviction on our part to basically admit that whatever we had thought prior to this, one has to just throw a large part of it out the window, because there's going to be a few events in your lifetime that massively change things. And we realized fairly early on that this was one of those events. So to just assume that nothing's changed would be massive folly. So we were fairly open-minded to say we're going to aggressively reposition the portfolio to our new view of the world. So you'll see here on the sell list that we pretty much aggressively sold off a lot of our SA positions. Let's go back to the previous slide. We sold a lot of banks. We actually went short the banking sector. Our single biggest short bet right now is the SA property sector. We think there is massive pain to come in the SA property sector. If one just thinks about the pain shopping malls have had right now, the amount of retailers that will go into business, risk and out of business, the amount of restaurants and shopping centers that will close, small line shops that will close, And then I think that the real long-term pain will probably be in the office market, where most large companies we're currently talking to in SA, for example, all the major banks and insurance companies, are telling us they're going to end up using 30 or 50% less office space in 2 or 3 years from now, as they've realized most of your admin staff and your call centers can actually work just fine from home. So we think there's going to be a massive glut of office space in SA. So as your current leases renew, you're just going to have massive downward reversion. So the SA property sector short has been a fantastic one for us. I mean, the shares have fallen a long way. I mean, we would actually like to have a bigger short one, but you've also got to look at valuation. But regardless of that, the outlook's so poor that we're fairly comfortable to stay short those names. And what we've done is we've said, in a really tough global environment, what do you want to own? You want to own the best global franchises with the most stable businesses, without debt on their balance sheets, with cash on their balance sheets, and ideally businesses that will benefit from more online, more internet usage, more work from home, and a further shift of offline to online. So we bought things like Facebook, Mastercard and Visa are just great franchises benefiting from the cash to card shift. Businesses like Microsoft and the SA market, a business like British American Tobacco that's fairly unaffected from this globally. Obviously, SA has been a real disaster for them with our very strange and inexplicable government policies on cigarettes. And globally, I think it's actually been a good time for the business. So massively reduced SA exposure, significantly increased offshore exposure, and actually increased the short positions in SA companies that will be mostly affected. I think that then another, I mean, I maybe just want to touch on then quite an interesting, okay, well, let's first look at our offshore holdings, and then I'll get to an interesting 1 or 2 trade examples. This is really the portfolio we've built of global names. We've been covering most of these companies for 5 or 6 years. They've typically been fairly small positions in our fund, as we've really liked the outlook of these businesses, but we've been more focused on SA opportunities, with the realization that SA is likely to be in an extended, probably 3 to 5 year recession, and there are scenarios where we potentially never bounce back fully from this. We think we've deemed it to be the right thing to switch a big portion of fund into these high quality global names, where we just are not that linked to the SA economic outlook, and where we can keep generating good returns for our investors without losing sleep over the poor political decisions being made in SA. So clearly, Prosus and Naspers is one of our biggest holdings. It's a business we really like. As I touched on, British American Tobacco, a business like Starbucks in the UK, L'Oreal and Estee Lauder being great beauty franchises, the Chinese exposure through JD.com being the Amazon of China and Tencent, and Philip Morris being another tobacco name, and then Scout24 is actually the largest German property classifieds website. So like the Private Property or Property24 website in SA, they're the dominant property website in Germany, and we're actually also an Auto Trader being a dominant second-hand vehicle trading website in the UK. So really a portfolio. We will also almost call many of these almost monopoly type franchises. And I guess the beauty of owning this kind of portfolio is that we've got to realize there's going to be a lot more volatility over the next year or two as the virus has second waves, as governments decide how to deal with the stimulus and the resultant deficits. So I think it really pays to be in these high quality franchises that in scenarios where the world ends up a fine place and things bounce back quickly, they'll do well, but they'll also massively outperform in the scenarios where there are second waves and that we do have a second round sell-off. And these are really the names you want to own in that kind of environment. I guess, I mean, maybe these are 2 interesting examples that I just want to touch on. I think it just highlights the benefits of investing in a hedge fund, and especially of keeping your fund small and nimble. So a business like Capitec has been a company we know extremely well. We've made significant alpha from this over many years. I think it's a company we probably know better than most fund managers in SA, just due to our long-term relationship with management and with the business. We didn't own any Capitec going into this. And then, as I mentioned earlier, we love environments of panic because we can sit there rationally looking at shares, keeping our cool, and taking advantage of other people panicking. So you'll see the amazing thing here is Capitec literally in a day, between the middle of the 18th and 19th of March, it fell from 1,100 or 1,050 Rand to 550 Rand. That's basically a large SA bank with like 50 million clients. The share price halved in a day, which is just complete madness. Now, I guess it always in hindsight seems easy to buy. Like, why didn't everyone buy at 550? We were in fact the only buyer. We bought the entire volume of the share at 550, whatever there was. And I think what you'll often find in fund managers is when a share moves like this, they will doubt their own convictions. They will say, is there someone out there? Does the seller of the share or someone else know something that I don't? And I guess you need, as a fund manager, as a good fund manager, to have the courage of your convictions to say, sometimes the market is just wrong and it's just someone else being a forced seller or panicking on the other side, and I'm going to take advantage of that. So as I said, we bought all the volume of this and at the bottom at 550 on the 19th of March, and we sold them the next day at 850 Rand a share. So that's 60% upside. In like a day, we made like 1.5% of alpha, clean for our investors, without taking market risk by one share having a massive forced seller in that share. So I guess that's something you can never get at a large fund manager like a Gray or Investec or a Cora or Prudential. They're just unfortunately too big. So even if they do this kind of trade, it's going to make like 1 basis point difference. So it just absolutely highlights the fact of being small, nimble. You can take advantage of these kind of trades. And also the other key thing is you can actually rapidly reposition your portfolio. As I said, we traded 100% of our portfolio in a month or two, allowing us to be repositioned and correctly positioned for the current environment. MTN was a very similar story. The share just completely fell off a cliff. I'm not going to go through the whole story again. We bought here well below 30 Rand, and again, it didn't bounce back like in one day, but like within a few weeks, you could sell those shares and close to 60 Rand a share is where we exited the position. So just a few great opportunistic opportunities where if you keep your cool when other people are losing their cool, you can add great value for your investors. So let's then end with our market outlook. We think that, unfortunately, I mean, we all live in South Africa, so it's not pleasant to say, but the SA economic outlook is exceptionally poor at present. We think there are various scenarios where things stay very, very tough. We're in an extended recession year for the next several years. Unfortunately, the reality is, from the data we can track, most companies are only going through their job cuts right now. So most companies didn't fire people during the lockdown. Firstly, they couldn't because people weren't in the office. They might have kind of just cut overtime initially, or maybe some companies did a salary cut, but they didn't actually fire people because they wanted to see how things play out. But now we've seen the last 2 weeks, probably like 15 JSE companies coming out with Section 189 retrenchment processes. So that's only going to hit the economy over the next few months, these job losses. And then the other really unfortunate thing is, in an emerging market like South Africa, people just cannot, or most of the population cannot properly social distance. So the reality here is, like, we consistently see the newspapers talking about when cases in SA will peak. The reality is there will be no peak. Things will keep going up till either everyone's infected or till we have a vaccine or cure. That is the reality we've got to face with here. It's going to be the story in SA, it's going to be the story in Brazil. There's no possible peak. We cannot go into a full lockdown again. People don't have the money to survive that, and government don't have the money to get people through that. So it's unfortunately going to be a very, very difficult year for SA. So we've positioned the portfolio to ensure we can continue to make returns regardless of that kind of economic outcome. And that's also why we remain very cautious of SA companies. We're also avoiding companies with debt, because businesses with debt just can't handle big economic shocks and big economic volatility. And it's unfortunately about an environment where we continue to expect those kind of shocks. So we've stuck with companies with cash on balance sheet that can ride through the difficult times. And we're avoiding shares linked to the overall economy. And then ideally, what we want is companies that will continue to grow, and specifically companies that will benefit from COVID-19. So businesses like Microsoft, most large SA corporates and global corporates have to rapidly move their people onto Microsoft Teams, where you can engage, where you can video conference with other staff, where you can chat as people work from home. So that's a business that's massively benefited from the shift to cloud. Businesses like Google and Facebook, while they're having some short-term impacts on revenue, they're actually seeing massively increased utilization and traffic, which leads to stronger revenues in the long run. And through Naspers, you get exposed to Tencent. It's the biggest gaming company in the world. And gaming has been a massive win. As young people have more time at home, there's been significantly more time and money spent in gaming. So those are a few of the examples of where our thought processes are with regards to that. So to just continue on the market outlook, as I said, we've got to stay nimble and flexible. We've got to be able to move the portfolio around. I think the reality of the world we currently live in, is over the next few years, returns from markets will be lower. I don't think it's going to be, the last 10 years has been a great period for global markets. It's not been as good for SA due to our very poor political decisions, but it's been a good period for global markets. We think for both SA and globally, we don't think overall market returns will be great. So picking a fund manager that can generate alpha outperformance will be much, much more important for both IBase and clients, because otherwise we think people will be stuck in a low return world where globally in all developed markets, cash is yielding you 0. Even SA now, cash is yielding you 4%. It's kind of the lowest it's been in most of our lifetimes. So cash and bonds are almost a guaranteed way to lose money, and equity markets will also be tough. So you've got to be in, you've got to have a fund manager that can generate outperformance if you want to deliver good returns for your clients. We've then constantly got to balance both caution and optimism. You can't be too cautious because then you can't participate in the market runs. And I think that is something that caught a few fund managers off guard. They were just so negative in March that they didn't deploy sufficient money in the market at that time. You also don't want to be too optimistic though, as we are likely to have volatility and second waves hitting us. So you've just got to balance those two and consistently play both of them off against each other. And I think the other thing you need to look for is you've got to look for a fund manager that's aligned with his clients. 10% of our fund's assets is our staff's own money. So every day we come in and think, how can we best manage our own money together with client money? It's not just a job for us. We're really managing our own wealth together with that of our clients. So if I look at where our returns are going to come from over the next few years, despite the tough market, I think we own some great global franchises that's going to deliver strong outperformance. However, I think another great source of return will be in SA, where we can be long the winners and we can be short the losers. So like in SA, we own a business like MultiChoice that's a real beneficiary from this lockdown. People are watching a ton more TV, not being able to leave their houses, and we can be short the banks that will have massive defaults on their home loan books, on their property books, on their credit card books, and we can be short property companies. So there's going to be nice uncorrelated outperformance we can make through being long and short the right shares in SA, together with this portfolio of global shares we have. And I think being a hedge fund and being small and nimble in a time of great volatility has been very interesting. It's actually been a great time for us at work, despite the fact that we've worked incredibly hard and really had lots of debates to figure out how things are going. But it's been an environment with many more opportunities to make money for clients than just a stable, steadily trending market. So I really think the next few years, we think it's going to be fertile ground for us to identify various opportunities from both other people's mistakes and purely just from the difficult global backdrop. All right, so I'm going to leave it there, and I think we just want to leave some time. I mean, I always enjoy the Q&A part of things, so we'd love it if a few questions could come through and we can address what's specifically interesting to you guys.
Thanks very much indeed, Jacques. So there have been a number of questions that have come through, but perhaps before I get to those, I mean, just to help me understand better, when you talk about acquiring some of the stocks you've showcased with us at the moment, with the Microsoft and what have you, when you acquire them, do you actually go long on them, or are they long positions, or are they just market neutral positions?
Yes, I think it's a good question. Our two different funds, in Pure Hedge and High Growth, it's slightly different. In Pure Hedge, because that fund is market neutral with very low equity risk, there we would always hedge them. So if we buy them, we would either short the JSE index, we could short the S&P index, or in many cases, we've actually shorted these SA companies who are very negative on. So you buy Microsoft and you short Growthpoint, for example, the trade we put on that's been fantastic. Growthpoint's down 30%, Microsoft's up 30% from where you bought it. It's been a real winner. So in the market neutral fund, you hedge them. In the high growth fund, given where we take a bit more equity risk, we can just buy some of them outright. So some of our Microsoft position, some of our Facebook position, our Visa, MasterCard, some of that's just purely unhedged, and you just own the long position. We do often hedge the currency back because we do want to manage how much dollars we have in the fund, because we need to smooth out the rand dollar volatility for clients. So as we buy many of these incrementally, as soon as we buy more shares in a Visa, we would often hedge back those dollars to rands to not expose clients to currency volatility when we don't deem that appropriate.
Yeah, Jacques, there's lots of questions coming around the operationalizing of hedge funds in the South African context. And, whilst, we know they're now, vested in a CIS structure to some degree, there are still some impediments in that. And perhaps you'd like to share, what those impediments might be, and particularly what you're doing as an industry or as a an entity to actually overcome some of those impediments. And I'm thinking specifically to the restrictions that on CIS fund of funds have in terms of investing in a hedge fund.
Yep. So look, I think the probably single biggest impediment in our opinion is the perception of hedge fund. Generally, when you talk to someone that's not invested, the perception is that it would be higher risk than a typical similar collective investment scheme or unit trust. So I think being the largest hedge fund in the industry, we've now deemed it to be, I think we think it's really our job to communicate to people why we're not higher risk, or actually lower risk because of the hedging tools we have available. But I mean, we're only starting on that journey now, and we've hired 2 new distribution people in the last month. We're probably going to hire 3 more. So we have representation in all the major areas of the country, so we can go out there and just communicate with IFAs, give them the comfort on how we run the business, how we hedge things, to just give people the comfort that we really are a lower risk asset class than what the general perception is. So I think that's going to be a main job, just getting our message out there, because we haven't done that because we were closed for such a big part of our history. We just haven't communicated with people. And the big allocators, the pension funds, the high net worth clients that are invested with us, they know this and they've seen this. But I think it's our job to get that out there. And then secondly, unfortunately, I think a key impediment in our way is that fact that collective investment schemes can't currently allocate and fund the funds to hedge funds. So I mean, we're going to make representation to the government and the regulator there. I mean, this is still being reviewed. We really hope that sanity prevails, because we just think from the data I represented, this is a great tool for reducing risk in a portfolio. But I think unfortunately, that's somewhat out of our control. So while we're going to try to influence that, and we can only do so much, we are never going to do much more on the things we can control. So we want to make sure on all the platforms, it's easy to allocate to us. We want to get better at communicating with clients. So for the last few years, we've been doing annual letters. We're going to do more quarterly communications, because I guess the other feedback we've had from clients is it's much more easy to understand hedge funds if we tell them how we make money, if we tell them about our ideas and our opportunities. So that's also something we can do better, and we're trying to get better at.
And then, Jacques, I mean, obviously the discretionary fund managers, play quite a big role in the retail space in South Africa, and so do the rating agencies, the likes of a Morningstar or a Fund House. Would you just share some of your perspectives on that segment and their attitude to working alongside hedge funds?
So I mean, we started engaging with them probably about a year ago, and in some of our initial meetings, they just said there's a massive hurdle for us not having a retail fund with daily liquidity and not being on the platforms. And without those boxes being ticked, there was no point having the conversation, because they couldn't recommend us really before we ticked those. So I think that last year, we've basically spent clearing those hurdles. So we launched our 2 retail funds at the start of this year, which is basically exact mirrors or replicas of our funds with a long track record. So fresh start, but exactly the same positions, and they'll deliver the same returns to clients. And then making sure we get on the platforms. And actually, we finally got listed on Allan Gray last week with High Growth, and as I said, next month with Pure Hedge. So I think probably over the next few months, we're going to go to them and say, we've ticked both of those 2 boxes, and let's talk about our funds, and let's educate you and debate with you the value we can add to your portfolio. So I think we are very optimistic on kind of getting allocated to those portfolios in the next 3 to 6 months.
Thanks, Jacques. And there's a question here too about, you spoke extensively about your alignment with investors, and I think, what's good for you must surely be good for investors. But you want to just talk us through that a little bit more, so people can understand what effectively that alignment means.
So, I mean, the alignment just means that almost all our senior staff, and in fact, everyone in our business, are invested in our funds in the same fund as our clients. So let's say in the High Growth Fund, the vast majority of my own net worth is invested in that fund, in the same fund that everyone else is invested in. So it's basically just saying we eat our cooking. If we've got a good month, all of us as staff is happy because a lot of our own money is invested in the fund. If we take pain and we have a negative month, we feel that with investors. So we just think that, and for example, whenever we hire a new staff, I don't know if any other business does that, but on day one, every single staff member in our business, we invest a substantial amount of money for them in our fund. So from day one, anyone that joins us thinks like an investor. They're immediately invested alongside our clients. And then for all of us, a big part of our bonuses or dividends out of the business goes straight back into the funds. And for most of our staff, half of their bonus on an annual basis goes straight back into the staff, into the funds, and are invested there for 3 years. So I think that basically this means at the end of the day, 10% of the assets we manage is our own money. And it's basically just, I think it's not a job for us. We're really running our own money with investor money. For most fund managers, a very, very small part of their overall fund is really their own money. It's mostly just client money, and it's mostly just a job for them.
Yeah. Maybe just shifting the conversation a bit further, Jacques. I mean, in the context of, what's happened around the world, I mean, there's obviously been some significant macro events that's unfolded. But, would you, how do you kind of do this overlay between kind of a bottom-up stock selection and going long or short on stocks with the sort of macro environment overlay as well? Is this something that you practice as a hedge fund manager?
Yeah, I mean, I think that's a great question, and it's been so key the last 3 or 4 months. So in general, we are primarily bottom-up investors. In most cases, we let the bottom-up company, and I mean by bottom-up, I mean company-level detail. So we're very close to our companies. We see our management teams regularly. I think we interact with them the whole time. So a lot of our information comes from the management teams and from how the companies are performing, and that drives our decision-making. However, any company operates within an economy, so they operate within the SA economy, within the global economy. And there are a few times in any fund manager's lifetime where the macro becomes incredibly important. And as a fund manager, you've got to stay close enough to the macro to realize which are the times where the macro, to some extent, for a period of time, supersedes the bottom-up information. And the last 3 or 4 months has absolutely been like that. So while we always keep an eye on the macro, typically we put more weight on the bottom-up. I think at the end of February, seeing how COVID was progressing, we realized that the next 3, 6, or 12 months was going to be a period where we've got to shift the weight to more of a top-down, macro-driven approach. So immediately in Feb, we put our whole team on figuring out how this virus is spreading. We dropped our bottom-up and said, we first got to solve this problem, because no one's got the answer for this. The world hasn't seen this in 100 years. So let's solve this problem and then translate that into how it impacts our individual companies. So it's having those two kind of both the tools in your arsenal and deciding which tool to use at various times.
Jacques, I'm very conscious of time now, and I see there's a lot of questions still coming through in the system. And perhaps I'm going to just leave you with this last question, then I'm going to close the session out, unfortunately. But you do want to just talk a little bit in a period when, you've seen this bifurcation between, alpha and beta to some extent, and you're seeing, a lot of pressure on active asset management as a discipline. How sustainable are the hedge funds pricing structure between, which I think you charge at the moment of the order of 1 in 20? Is that right? Do you think this is a sustainable pricing structure for the future?
Look, so I think fees are a key issue for investors. However, obviously all the returns we always show are net returns, so we don't show gross returns. The only thing that the client gets out is net returns. So all my numbers, the outperformance and inception has all been on a net basis. I think fees are important, but as long as our view has always been, as long as we can deliver great industry-leading returns to our clients, there are going to be people that we think are open-minded enough to realize if I can get a significantly better net return and I pay higher fees, that is surely a better decision for my clients than picking the lower fee option. If you were in an index fund and just like a cap switch index fund, you're still down 15% at the end of May, our fund's up 4% after our fees. So, and I think in the world we see over the next 3 or 5 years, it's going to be a low return world. There's going to be low return from beta, and you're going to need more alpha. We think that's going to be a great time for hedge funds, because we're really going to, if we can deliver on our historic kind of numbers, which we have every intention to do, we think it's really going to show investors why you pay the fees and the value you get from those fees for your clients. Because we just think being in beta products with low fees is not going to be a great outcome for anyone over the next 3 or 5 years. So I think this is actually, a great time for our business, especially this year today, to really show the value we can add for the fees we charge. And obviously our job's going to have to be to keep showing clients that they get the real value for the fees they pay us.
Jacques, thank you very, very much. I'm very conscious of time restrictions for everybody that is, and just want to leave you on this note of saying, congratulations on your 22nd anniversary tomorrow. I hope you're popping a bottle of Moët Chandon in the office. And secondly, well done on your performance awards. Certainly what I've seen here is, consistent performance over a prolonged period of time. So well done to you and your team at Peregrine Capital for those achievements. On that particular note now, I'm going to close out by just letting you know But we have another series of webinars we're running during the course of next month in July. If Sam could just bring up that slide deck for us in a moment. But next week we have a great conversation with stalwarts from the industry, where we have two, founders of respective parts of their business. So Guy Toms from Prescient Asset Management, who founded Prescient, and Thijs du Toit, who was the founder of Coronation and Rootstock Investment Management, will be joining us to talk about 30 years in the investment industry, the key insights and learnings that they can share with us of what they've gone through with from the dot-com period to the global financial crisis and beyond that, to share what learnings they've had over that particular period as investment managers. We then have Sanlam talking about living annuities again, and then we have Portfolio Metrics talking about the value of advice. They've done a lot of academic studies, interviewed 200 advisors across the UK, and they will be talking about the value that a financial advisor can bring in the client conversation as well. So please bookmark these sessions. Please join us then. Thank you very much for joining us today. Please go back and like the session if you want to, and hope to see you again in the virtual network. Thank you.